Welcome to the Daily Update, where I'll go over the action in the market for Monday, November 13th, and then we'll see how things look for Tuesday, November 14th. It was kind of a positive day. We did close down, and we were well below average with volume. But the fact that we pretty much set the low right at the open, down at the daily pivot that I'll show you, and then we spent the rest of the day coming back, and then we chopped more or less sideways. It was kind of one of those days where, yeah, we were down and you could take some negative things away from this, but at the same time, the intraday action made it look a little bit more positive. Now, we have a really big economic report coming out before Tuesday's open, and that'll be CPI. And that is why the market was pretty much flat by the time we closed. It was why volume was below average. There's a lot of anticipation for this report. And of course, three things can happen. The report could come in market friendly, and that could end up taking us higher. It could come in unfriendly to the market and take us lower, or it might come out a little bit mixed and the market's not quite sure what to do, and we end up just continuing to chop sideways. We have to be prepared for all three of those things at the same time. But our technicals are still positive. We're still dealing with somewhat of an overbought condition in the short term. And we're right at resistance right now. We fell just enough to come back down to the two trend lines that we've been following. Before I get started, for some reason over the weekend, the video that I did for Monday's session, it got picked up by the YouTube algorithm. And I just saw this massive expansion of people that were viewing the video and a massive expansion of people subscribing to the channel. I just want to say welcome to all of you. I hope you find this useful. I do these videos every day, and I'm just honored to be a part of your life. I'm just amazed that people want to watch what I put together. Even though I've been an educator for a long time, I still have a real appreciation for the idea that I can have information and then share that with you. For those of you that have been watching the videos for quite a while, I've been really posting for a couple of years now. Thank you for your loyalty as well. And it just goes very appreciated. And so I just want to say a heartfelt welcome to new folks and a heartfelt thank you to those folks that have been watching for quite some time. All right, let's go back and talk about what happened. Right at the open, we had a gap lower open, but we kind of just stayed right there. We didn't really shoot much lower than that. And that set the intraday low, and it was right at the daily pivot at 43.96. Then we rose back above, and we got above the unchanged level, which quite often acts as overhead resistance on a down day. Well, we just chopped around the unchanged level, a little bit above, a little bit below, and then we just stayed in that same basic range until the close, but we're still above 4,400. That's more psychological than anything else, but we opened below that, and then we were able to come back and close above 4,400 is positive. We were down 0.08%, virtually unchanged, but it goes in the books as a down day. We were well below average with volume. And our technicals, as I said, we're still leaning more towards the positive side. CPI is going to come in and hopefully provide some clarification for all of that. And that's what CPI is about: inflation, interest rates, growth concerns. And the market really is fixated on that. We're also dealing with earnings season. We're slowing down a bit in that area, but we're still dealing with those things. And then the geopolitical events, what's going on in Israel. And then there was some more bombing over the weekend that the U.S. did in Syria. They are Iranian-backed targets that the U.S. decided to go in and try to take those out. Is that going to escalate things? Because Iran is kind of behind the scenes in all of this, and there's also more fighting going on in the north in Israel. Is that going to escalate things as well? All right, some comments that we can make. We're still above 4,400 for the S&P. Stocks did rebound when interest rates started to fall right after the open. And there's the next point that I'll go into this in a little more detail. There was some reason for the market to go down. The futures were down about 0.5% when they first started trading Sunday afternoon and evening. But then as we got closer to the open, there was a little bit of a bounce up to that, but interest rates were still up, and then they topped out and started to come down, and that's when stocks started to go back up again. And this was kind of the big news item over the weekend. After the close on Friday, Moody's, they downgraded the U.S. credit outlook. Now, this isn't the rating for our debt. This is just their outlook going forward. And they changed that to negative, where it had been stable. And it's based on all these partisan politics. You've got the Republicans and the Democrats, and each side thinks the other one is evil, and they can't really come to any conclusions. There's very little actually going on in Congress right now, and a lot of it's being done by executive order, which you might agree or disagree with that, but that's not necessarily the way the U.S. was designed. And that there's real big budget deficits that are still very large, and we're still adding to that. And if you're not really aware of this, the economic, I guess, philosophy that's been implemented is a thing called modern monetary theory. Since we have the strongest currency on the planet, it's like, no problem, we can just print more money. And if inflation gets out of control, we'll just raise interest rates. And then when inflation comes back down, we'll just print more money. And even though it's never worked when it's tried a variation of this in times past, they think, well, this time it's different. And Moody's didn't really like that. So they ended up downgrading the debt outlook or credit outlook, but the credit rating is still at AAA. So that has not changed. And this was putting some pressure on futures when they first opened. It was bumping up interest rates, but then that seemed to work its way out as the cash market opened in Monday's session. Oil did close up at 78.34. We're wondering, is that as much of a focus right now? That could change. In fact, that's one of the poll questions that I ask on the community tab in the YouTube channel. Do you think oil is going to come back into the picture and really have some influence, or is it kind of fading away, and will it stay faded away? On a short-term basis, we have the Stochh RSI, the Williams Percent R, the CCI 14, and the stochastics. Actually, that should be the CCI 20. That's a mistake on here. On an intermediate term basis, we still have the CMB composite. It's coming down, but it's still extreme positive. The PMO studies and the rate of change, because we had virtually an unchanged day, that hasn't really changed yet as well. And I'll show you all the charts here. The scenario has been the same scenario that we've been dealing with for over the last couple of months, where the economy is stronger than expected. Now we're wondering, okay, maybe this soft landing thing is going to be possible after all, and it's not necessarily stronger than expected. That's why everybody's waiting for CPI to see if inflation is still continuing to fall. Is it under control, or is it going to start spiking back up? We do know that the Fed has been already keeping rates higher for longer. There's really no talk of rate cuts. And now the big variable is, are they going to end up having to raise rates? At least it's not looking very likely at the next meeting in December, but going out into the future. I'm still waiting to get some more definitive information about what's going on in the Chinese economy. The only reason I pay attention to that is because so many S&P 500 companies do business with China. Of course, what's going on in Israel, we're watching oil and then earnings as they are released. The dollar was up and interest rates were also up. They were virtually unchanged. You had to go out further in the decimal points to get that to go up. But they were up slightly. You could also say unchanged if you would like. The 10 to the 5 is back to being inverted, as is the 10 to the 2 year and the 10 to the 3 month. The reason why we watch these is when they go back to being normal again, that quite often starts the countdown to see, are we going to go into a recession anywhere from 3 to 6 months to a year and a half later? Because that's typically what happens. We go inverted, then it goes back to being normal, and then at some point down the road, a recession will occur. So that's why we watch these. Sentiment was unchanged. It was at 41, where we closed at 41. It's still negative. We did get a lot further down where we were getting extreme negative, and we're slowly but surely starting to come back up with that. And our trend is still positive. This has not changed. The ADX is still trending, but it's below its moving average. So it shows that it's a weakening trend for right now, and it's below its moving average, as I said, but we're still above 20, so that is a trend. Right now, I'm changing our bias to mixed. Now, we had just a little tiny down day, mainly because what's going to happen with CPI coming out? What's that going to do to the market? We've been seeing for over a week now below average volume. CPI comes out, the market has a chance to react to that, and that could really send the market one way or the other. Or are we just going to be on a treadmill and end up where we started, where our momentum is still positive? Economic reports that came out, we just had the Treasury budget, not a big market mover. I don't have a chart to show you. We were down 66.6 billion. Now, that's kind of a weird number there. Where last time we were down 87.9 billion if you look back a year ago. And then we were virtually unchanged with interest rates, even though we were up slightly. We're at the 4.63 area where we're above the 4.02 level, which when it gets above that level, according to RenMac, that's when it starts biting into corporate profits. Here's the intraday chart where we put the low in right at the open. We gapped lower right down to the daily pivot. And the cool thing about these pivot points and S1s and R levels and all that stuff, we know these before the market even opens. And I found the ones on the 10-minute intraday chart to be very accurate, because a lot of the algorithms and automatic trading, computer trading that takes place, which can be anywhere from 60 to 80 to 90% of the volume, they put those into their algorithm and they say, okay, when we get to this level, start buying. When we get to this other level, start selling. Well, we came down to the pivot and then just clawed our way back up to the unchanged level, and then spent the rest of the day dancing above and below the unchanged level, only to close down just a little bit. Looking at growth versus value, see the green lines, I know my colors, believe it or not. The blue line is a little bit on top here, so it outperformed slightly, even though both were down. This is showing a little bit of an improvement here. Even though we opened lower, and that's reflected right here, we also spent the day coming back with our growth to value ratio on the intraday chart, and we closed pretty much at the high for the session. So since November 3rd, that was the big Friday up day where we really went down. We have been seeing growth outperforming value here, and that could be under the surface more positive. Then when we look at an end of day basis, we ticked up with the growth to value ratio here, not really breaking out or anything, but the fact that it's going up is positive. And then we look at this other growth to value ratio where it is actually starting to outperform here. It's breaking out above these previous highs, and that could be positive for the market. Then I don't show this all that much, but I mention it in every video. I just wanted to bring it up here. Small cap growth to small cap value. It's been chopping sideways, and that's what I've been saying, even though we're still in a longer term uptrend, because the blue line is above the red line. But we are showing some improvement here. The small caps have been under so much pressure. To see anything positive is you have to dig a little deep to see that. And even though we've been coming down with the index, we've been chopping more or less sideways when you compare growth to value. That could be positive. And then mid-cap growth, which I have been showing this chart, it's starting to break out above these previous highs here. And that could be positive for the mid-caps. And we want the small caps and the mid-caps to be in positive uptrends and to have them be strong. That helps the S&P to be strong as well. Here's the condition of the trend. The ADX is below the moving average and declining, but it's still above 20. So we're in a weakening trend, but it still is a trend. The green line is still on top, so we default to the positive side. Short term, seeing pretty much that same thing with the ADX below the moving average and the green line is on top. Both are above 20. We're keeping an eye on the VIX here as well. There's really no specific dates in here, so we're just kind of following this. And we have been seeing the VIX going down, but where we're seeing some interesting things happening is in the equity put call ratio, and I'll bring that up here in just a moment. The Ulcer Index is continuing to drop off. That's another fear gauge, and it's down below its moving average. Here is the VIX, where we came up just a little bit with the line chart as well as with the bar chart, but we're still below the moving average, and we're still well below 20. So we're more in a not a real fearful environment right now. Volatility of the VIX continues to drop off when you take the bigger picture, but we were pretty much flat in Monday's session. It didn't really change. The VIX to VVIX ratio is starting to turn down. This is longer term, and this could be turning things more positive. And then I've changed this chart where I used to have the VIX to VVIX the VIX to the 3-month average of the VIX on here. It was so messy to try to pick this out. I made that ratio invisible, and I'm just plotting the moving average here where it is starting to come down as well, and that could be positive for the market. The VIX to move ratio continues to decline, showing that Stocks are not as volatile as bonds right now. And here's the 1 day, which again, this is the last chart that I get, and it's many hours after the market closes. So I'm never quite sure when this is going to be updated here. We did decline with the equity put call ratio, where we saw it really spike up before the weekend, which only goes to reason. People can't get in or out of the market over the weekend, and most people are long in the market, and so they want to hedge themselves ahead of when they're pretty much incapable of doing anything. So we saw the put to call ratio really going up. Well, in Monday's session, we saw some of those hedges coming off, and so that was an overall decline on the 1 day chart. But we're still going up with our 5 day chart here. And at some point, if we finally top out and start to come down, that could be positive for the market, but it hasn't rolled over yet. The longer term equity put call ratio is still continuing to go up, and that's longer term negative. We were pretty much flat with this fear gauge and also pretty much flat with this other fear gauge. Not a lot was decided based on sentiment. This is another warning sign. We declined again with our risk on versus risk off ratio. When the risk on is going up, that's usually more positive for the market. When this is going down, that tends to be more negative for the market. Looking at our advanced decline line based on price, we declined, but we're still above the moving average. Based on volume, we're still below the moving average and also declined slightly. This is still holding up pretty good, though. We're seeing an expansion of new highs, even though it was less than what we saw on Friday. We're seeing a contraction of the new lows. And so that's helping our 5 period and our 10 period to look more positive. We're still above the midpoint with our advanced decline ratio. We're chopping around a little bit, but both the blue line and the red line are above zero. Accumulation distribution. This is trying to gauge what the smart money is doing, and it looks like they're buying right now, according to this indicator. And the chicken money flow, it declined just a little bit, but we also follow this red moving average, and that is showing some improvement that the smart money is likely buying. Here's the daily chart where we're right back down to this trend line that we made from this top to this top here. And remember, I draw the lines on here, so they're not computer generated or anything like that. I just kind of have to eyeball it. So I could be a little off here with some of these. I was looking at some charts over the weekend that had it. I said we closed above resistance, where those other charts had us right at resistance, and we're pretty much right at that point right now. Then on the bottom, we really dropped off with volume. And volume is also dropping off more on an average basis. We're actually starting to go back below zero. For the last 6 trading days now, we've been below average with volume. The force index is still positive, even though it did decline just slightly. The Stochh RSI is still extreme positive, as is the Williams percent R, and the CCI 20 is just barely going above 100. So this has more room to run to the upside. It was the CCI 14 that we were watching last time. That's fallen off, where the CCI 20 has been inching ever so higher. Looking at our stochastics, we're extreme in the short term, intermediate short term, and the long short term. And the reason why I say that is this is a further subdivision of the short term. All stochastics, in my opinion, are short term indicators. And I just break them down into really short term, kind of short term, and then longer short term, if that makes sense. The rate of change going back 10 periods, it is declining, but we're still getting an extreme period. This measures the close that we had on Monday with 10 periods ago, and it shows that we've gone up pretty far, pretty fast. Sometimes this will mark a top. Sometimes it just marks a slowdown. Sometimes we just end up chopping sideways after that. The standard deviation is also coming down. This looks at the average price over the last 10 periods. It's not measuring direction. It's just measuring velocity. And it's still giving us a high reading, but coming down off of an even higher reading. Looking at the cumulative advanced decline line for the NYSE, we did see a little bit of weakness. We were pretty much flat to slightly declining with our regular advanced decline line. And we're still working off of a death cross here with our other NYSE advanced decline line, even though it ticked up just a little bit. This is a warning sign. We've had 5 days now, I believe, where the Swenlin trading oscillator, it hit kind of an extreme positive reading, and it continues to go down, even though we've been chopping sideways, and then we had that good up day on Friday. This is still continuing to fall, both based on price and volume. Now, sometimes we're led astray by this, but this did give us a pretty good heads up right before we hit the bottom. If you really look at this, you can see this started to turn up before we hit the bottom based on price. So we just want to be aware of this. The go, no-go system remains positive with the fluorescent blue bars, and the TTM squeeze is continuing to show that momentum is positive. The balance of power is positive. The highest high, lowest low, we're coming up to the blue line, which is the highest high value, and that's starting to go up slightly, and we're above an advancing midpoint. The CMB composite is coming down, but still extreme negative. Again, I put these black lines on here, so there's nothing necessarily magical about that. I look at this in the long term, and I kind of eyeball where were we extreme, and then that's where I put the line. The 100-period moving average, we're above the simple moving average, and that's kind of a big deal. We spent a lot of time in between the simple and exponential moving average. The fact that we're still above that for right now is positive. And here's our moving average tree where we're above all the plotted moving averages here. If we can keep going up, it'll help turn these lines back up as well. The Erin is still looking more positive. It's above the zero line with its oscillator because the green line's on top. That means that buyers are in control. The red line coming down means that sellers are waning. And so when you compare the two, the oscillator is positive. And we're coming up to the upper side of this Ichimoku cloud, which may be providing overhead resistance. Can we break through that? It would turn much more positive if that could happen. The vortex continues to be positive with the green line on top. The ease of movement was flat, but it's still above zero. That's still positive. And we're still kind of inching a little bit higher here with the bullish percent index. We're not at 50 yet, but we continue to go up. Even with some down days that we've had, this is continuing to go higher. The summation index based on price and volume are positive, and we're crossing back above zero based on volume. And the NYSE, which is a broader measure of the summation index based on price and volume, we're still going up based on price. We're flattening out based on volume. We've switched over to neutral for the Elder's Impulse system for the S&P 500. The RSI still above 50 with the 14 and the 9 period and not extreme positive. On balance volume is still above an advancing moving average, even though it ticked down. On balance volume is one of the oldest and one of the first indicators to ever be developed by Joseph Granville, I believe his name was, where if we have an up day, all the volume is positive. If we have a down day, all the volume is negative. So it doesn't really let you see inside, but so many indicators are based on balance volume. And a lot of people watch this. That's why I also have a chart here. Looking at the 200-day simple moving average, we ticked up just a little bit with the S&P, and we actually ticked down just a little bit with the 50-period moving average study. On a momentum basis, we're still going up with the PMO. We're also advancing based on price and volume and crossing above the midpoint. We're no longer extreme positive with the PMOs that are rising. We are getting extreme with the buy signals, but we're still positive with the PMOs that are above zero. The NYSE bullish percent index ticked up just a little bit, so it's showing a tiny bit of an improvement, but we're still below 50. And this is kind of encouraging. We're in Friday's session when we had the update, we ticked down with the NASDAQ 100 bullish percent index. Well, in Monday's session, we ticked back up and we're above 50. So that's looking a little more positive. Based on a short-term look at momentum, the slope oscillator is positive, and now we're starting to get into an area that could be extreme. The MACD is above zero and advancing, so that's more intermediate term with momentum looking positive. So here we look at all of our different oscillators. These are the short-term oscillators on the top. Then we have 3 intermediate-term oscillators in the middle, and then longer-term oscillators on the bottom, and they're all looking more positive. And we came back down just a little bit here with the standard deviations. We were just barely going into the +3 standard deviation. That means that we've gone up a little too far too fast. We're coming back down into the +2 standard deviation region. The Chaikin oscillator still above zero and positive. The money flow, even though it was flat to slightly down, it's still above 50. That's positive. The ultimate oscillator, after giving us an extreme positive reading, which we don't see very often, has been declining, but it's still above 50. The Copic curve continues to be positive. And the Pring bottom fisher is giving us a signal, but as I said over the weekend, I wouldn't necessarily pay attention to this. Now watch it be a full-blown great signal. This is really good at picking after we've been going down and setting a bottom and then coming up out of that bottom. We've been chopping sideways as this signal was generated, and we're not getting a real low reading on here. We had what looked like a pretty good signal here, but by the time it actually generated, we were chopping sideways and then ended up going down after that. The parabolic SAR continues to be positive with the dots underneath, and we're right back down to this trend line, the green trend line, and we're just a little bit above this longer term trend line here. Can you tell the market's at an inflection point here? We've got CPI coming out, and we're at a point where we could break and go higher and turn more positive, or we could also justify going lower from here if CPI comes in hot. And I haven't been showing this all that much, but the special K daily chart, this is a very long-term oscillator. It's still negative, but starting to turn back up. If we can cross above the red line, that would turn this more positive. Looking at Dow theory, we were up with the Dow, we were down with the transports, we were down with the utilities. And so the transports continue to underperform the Dow, and the Dow is outperforming the transports. And then here, this is not encouraging. We want to see the transport ratio with the S&P really going up. That produces a lot more strength in the market. We're continuing to see this ratio going down, so that's a warning sign. The Staples S&P 500 ratio continues to decline, and that could give some good support to the S&P. And the S&P to utilities ratio is continuing to go back up. We've had a couple of up days now, and that could also give support to the S&P. And then a longer look at the 10-day average of the S&P highs minus the lows, we're above 50 and advancing after getting an extreme negative reading. This is turning more positive. This is more intermediate term, actually. Then we look at the 19-day exponential moving average of the advanced decline ratio. We're still above zero based on price and volume. The micro caps are still below 100. They were virtually unchanged, down just a little bit, but did not set a new 52-week low. The Heiken Ashi chart still is positive. The Kegi chart remains positive. The Renko chart is positive, and the three-line break is trying to turn back more positive. But the equal weight index, that's the red line, continues to underperform the S&P, which is a weighted index. And so we're seeing this ratio really going up. This means the big mega caps, they're the ones holding up right now when this ratio is going up. So we're not necessarily seeing broad participation. But for most of 2023, we've seen this ratio going up, and that's where we're getting the gains from in the S&P. The Dow is still above its 50 and 200-day moving average, and we're just getting ready to show a death cross here. If we can stay above this, it may turn this back up and actually negate a death cross. The diamonds have switched from being positive back to neutral. And the NASDAQ 100, it held up. It was still down in Monday's session, but we're still above this all-time high, this red line that I have here. So far, this level has been holding. But we switched back over to neutral for the QQQs, which is the ETF for the NASDAQ 100. Looking at the momentum, the PPO is above zero and advancing, so that's still positive. The NASDAQ is still above this R1 level, and even though it was down slightly, it's still holding up for right now. And we're right in between the 61.8% retracement level with our Fibonacci chart and the 50% level. If we get a friendly number and we really start to go higher, are we going to be able to break through this Fibonacci level? The small caps, they were down just a little bit, but they're still above this pivot point right here after working off of a death cross. And when we look at the Russell 2000, we're right at 50 with the RSI. We're working off of a death cross here. The momentum is still positive with the MACD, but rolling over just a little bit. And we've switched back to neutral, where we were neutral after Friday. We're also neutral after Monday with the Elder's Impulse system for the small caps. The mid caps also still above this pivot point, but below both of the moving averages and working off of a recent death cross. And the mid caps still remain neutral for the Elder's Impulse system. The FANG index was down just a little bit, but still above its 50-day moving average and still in a longer-term uptrend. And we're still above this green trend line here where I drew from this high down to this high. We're still above that for right now. We closed just a little bit below the 8,000 level. In our arithmetic scale, we're still above this longer-term trend line going back to 2009. When we look at growth of value, the Qs are still outperforming the S&P. We saw a bit of an improvement with discretionary to the S&P, and large cap growth is outperforming large cap value. So our other growth to value ratios, the large caps, mid caps, and small caps are all showing some improvement. This is longer term, and we're still showing some improvement here with our new highs, new lows study. It's going back up, but we're still below zero because the black line, which is the indicator, it's still above zero, and that's slowly turning the moving average back up. When we look at a broad range of the new highs minus the lows and take a 5-period moving average of that, we're still below zero. This is suggesting that there's not broad market participation in what's been happening. The dollar continues to be going up, and that could provide some headwinds for stocks. The financial sector is still above its 50 and 200-day moving averages. And here's the 10-year bond where it was just up slightly with interest rates. It was virtually unchanged. You have to really go out a few decimal places. And we were down, and we're just a little bit above the 50-period moving average based on price. Momentum is still positive. We're still above 50 with the RSI. Looking at Tom Bowley's research, where we're coming into this point now, we might be entering later on, where the 10th through the 13th tends to be positive. Now we could be entering a time of negative seasonality from the 14th through the 20th. We'll have to see if it plays out that way before we turn more positive again later in the month. So what's our outlook for Tuesday? CPI, that's kind of what everything is about right now. We're still dealing with earnings season, the situation in Israel, and I also added Syria to the end over here. This is the third bombing run that I've heard about anyway that's happening in Syria. And what's Iran going to do anything? Are they going to do anything about that could potentially escalate this? The technicals, we're still positive, but we're right at resistance now. We fell just enough, and we will be getting CPI. That's the big one that we'll be talking about in Wednesday's video, and then keeping an eye on the geopolitical events. Here's the economic calendar, where on Wednesday, we're going to get retail sales and PPI. Those are two pretty big reports. Later in the week, I think industrial production and capacity utilization are rather important. And because they're leading indicators, we'll get housing starts and building permits on Friday. Looking at the Stock Traders Almanac statistics, we are now coming into options expiration week, where we're up about 60% of the time and down 40% of the time. But for November 14th, we are neutral to negative pretty much across the board with the Dow, S&P, and NASDAQ. We will be on the 10th trading day of the month. CPI is coming out. We're looking at the green dashed line. We do see some weakness here. And we're wondering, are we going to continue to go up on this other chart? This is a pre-election year where the current president is running for re-election. Doesn't mean we're going straight up. There are times of little downward movements here. And also looking at this seasonal chart as well. Are we going to come into this more weakness, or are we going to favor the side of being more positive? We look a little bit more positive here, going back to 1950 with this seasonal chart, but we could be coming into this period where we see some downward movement. The NASDAQ also, according to Stock Traders Almanac, we're about, and I need to switch over to the right part, where we might see some weakness coming into the NASDAQ as we get more into the middle part of November, and also potentially some weakness with the S&P 500. And then keeping an eye on Bitcoin, where it's got up to the 38,000 level. It's dropping back down. We're in the mid 36.5 area right now after giving us a recent golden cross. So our scenarios, we're not going with the down one because none of our charts really support that. If anything, we are leaning towards the positive side. It's going to depend on how things close. You remember, some of you are new and haven't been watching these videos for very long. Whenever I enter a long position, I get in as close to the close as possible, and I only go in the direction of the position. So if I'm going long, I only get in if we're actually up on the day. If we have a down day, I don't trigger anything new. That's my own philosophy, because it's the amateurs who open the market. It's the professionals who close the market. And I found over the decades of doing this that you avoid a lot of mess by this idea of buying on the dips or buying on weakness. That ends up losing more than it ends up winning. That's my conclusion. It may not be your conclusion, but we're right at resistance right now. Even though we still are positive, we're dealing a bit with a short-term overbought condition. We're not going with the sideways trend because there are a lot of sideways strategies that I implement. I'm not implementing those right now because we are in a trending environment. The warning signs, the daily and weekly special K charts still are negative. The longer-term equity put call ratio is going up. That's negative for the market, and the 5 period's also going up. The risk on posture is back to showing some more weakness. Our longer-term new high, new low study is negative, but it's trying to come back up, but it's not above zero yet. The Russell, the small caps, and the mid caps are working off of a recent death cross. The financial sector, it did generate a death cross a little over a week ago, but we're right back to its 50 and 200-day simple moving averages. The positive signs on a momentum basis for the S&P and NASDAQ, we are still positive. The parabolic SAR and the vortex indicators are positive. The BPI, the bullish percent index, continues to hang in there and is still looking more positive. Small and mid cap growth is positive. So our conclusion, we're positive and we're at resistance. In the short term, positive at resistance, slightly overbought, a little bit overbought in the intermediate term, but still positive. And we remain positive in the long term because we're above the 200-day simple moving average. Thank you. I really hope you found this helpful. I hope you have a really good day, and I will talk to you in the next video.